Hello investors! Welcome to the channel. Here I talk about long-term investing in companies that pay a dividend. This is known as dividend growth investing. My name is Michael, and today we're going to start off with looking at how the market ended for the week and then look at stock futures. Just taking a quick look at the major indices for the week. For the S&P 500 index, it is down 4.78%. For the NASDAQ index, it is down 2.30%. And lastly, for the Dow Jones index, it is down 5.55%. The markets are down this week as more news comes out as a result of easing quarantine restrictions. As one might expect, due to the easing of quarantine restrictions, the number of cases in the pandemic has increased. So let's jump straight into the news to see what's been affecting the markets. As you may all know, parts of the United States have begun to open up its borders and allow people to come out of the quarantine. As a result, as more and more people commingle with each other, the pandemic has begun to spike up in the amount of cases. Just this past week alone, states from the South and the Midwest have begun to see a rise in cases resulting from the virus. Many people are calling this the second wave. However, it is just the first wave. As more and more people commingle with each other, the virus will most likely spread and the amount of cases that result will increase significantly. This will most likely hinder the markets. In addition, there is a second wave coming from the eastern side of the world. Many people from Asia are experiencing new cases in the pandemic, and as a result are considering to once again go into quarantine. As more and more people are locked down into quarantine, many things are affected. For one, the oil market and gas market will be heavily affected due to less travel and less demand for oil. Therefore, I expect to see another drop in oil prices as well as oil commodities. As a result, some people may think that certain alternative commodities such as gold would be a safe haven. However, I disagree with this opinion. As the price of oil falls, this is most likely the best time to buy into companies which are the main distributors for oil in order to pick up more shares at a favorable price. In other news, the Federal Reserve Chairman Jerome Powell expects that the recovery in the market and in the job market to be an extremely long one. In a recent interview last week, Jerome Powell has played down the surprise and welcoming news of the jobs report. In fact, Jerome Powell cites that millions of Americans are still out of work and suggests that it would take many years in order to return to normalcy. Although it is true that the job loss and the unemployment rate has fallen from 16 to 14 to about 13%, this number is still incredibly high. In addition, if a second wave of the pandemic returns, then we should expect to see that the number of unemployment claims will rise once again. It is important to note that over time, there will be a recovery both in the health sense and in the economic sense. However, the road to this recovery will depend on how well we face the pandemic. Obviously, the more that we social distance and the quicker that we find either a cure or a vaccine to the virus, then the quicker the recovery will be. So the long-term view of the economy as of now is the following. Number one, the second quarter will be the most negative economic numbers the U.S. has experienced so far. Number two, the third quarter will most likely see a sharp recovery and will expand for a while, assuming people are able to find jobs and the pandemic is contained. This is due to the fact that once the economy and the quarantine restrictions are lifted, people will continually find jobs for the next following year in order to survive. However, once jobs are found and people begin to get back on their feet, the economy should be on the right path to recovery, and we might see a V-shaped recovery. However, I'm not too keen on that. I think that it will be most likely a slow and steady curvature. In addition, Jerome Powell reports to Congress about the pandemic's effect on the economy. Earlier, Jerome Powell will discuss the Fed's monetary policy reports in front of Congress. His report will give an overview of the economy that the Fed will present to Congress twice a year. In this report, Jerome Powell elaborates that he's pessimistic about the outcome of the economy. In fact, he expresses his concerns that many people will not be able to return to their jobs after the pandemic is over. What's more, in a recent report, Jerome Powell believes that the unemployment rate will only fall down to about 9.3%, which is still incredibly high. This is about a 3% difference from last year. Therefore, it is unlikely that the economy will bounce back extremely quickly. Most likely, we will not see a V-shaped recovery. In addition, there was also the monetary policy report given to Congress by Jerome Powell. In this 66-page report, there are a few main takeaways. Number 1, the Federal Reserve is committed to use its full range of tools to support the U.S. economy to promote maximum employment and stabilize prices. This means that if the economy tanks, then the Federal Reserve will step in to save the economy. Saving the economy will most likely result in bailing out failing businesses, providing more employment loans, lowering interest rates, and giving out more stimulus checks. Bailing out failing businesses will help people stay employed to provide goods and services. Providing employment loans will allow business owners to keep their employees employed and promote economic growth. Lowering interest rates incentivizes people to borrow more money at cheap rates to spend in the economy. For example, people can now borrow money to purchase real estate or homes through mortgages at low fixed interests. Lastly, giving out more stimulus checks will help people make ends meet and does not increase inflation because in this report, there's research that shows that the majority of people who have received a stimulus check are actually saving money rather than putting it back into the economy, and therefore this avoids increasing the overall money supply. As a result, inflation has fallen from 1.8% to 1% as of this recording. In addition, less demand in goods and lower oil prices due to less travel have also lowered inflation. Number 2, major job losses occur with lower social economical groups. Low-wage earners are more likely to have experienced permanent job loss. Low-wage earners are disproportionately employed by small businesses. Small businesses typically have fewer financial resources, which may result in permanent shutdowns. High-wage earners, on the other hand, will most likely keep their jobs but receive a pay cut. Number 3, individuals with low credit ratings face tighter borrowing conditions, but those with strong credit profiles have lots of credit available. The takeaway here, if you make a lot of money and have a high credit score, then you'll have easier access to borrow money. But it's unlikely that you'll need to borrow that money in the first place because you already have money to start with. Conversely, if you're lacking money and have a terrible credit score, then things are going to be extremely rough for you. However, there is a solution. I suggest that you watch my video based on the comprehensiveness of credit cards with high cashback rates to not only help build your credit, but also save some money while you make necessary purchases in order to survive. Moving on from here, I want to talk about private equity investments. So, To start off, a private equity is an alternative investment class and consists of capital that is not listed on the public exchange. Private equity is composed of funds and investors that directly invest in private companies or engage in the buyout of public companies, which results in the delisting of the public equity. Here is a good diagram of what a private equity firm does, and simply put, a private equity is a large pool of money managed by the extremely wealthy people and corporations. These wealthy people and corporations use money to invest in companies and buy them outright. These buyouts are done through leveraged buyouts. Leveraged buyouts is when one company acquires another company using a significant amount of borrowed money to meet the cost of acquisition. The assets of the company being acquired are often used as collateral for the loans along with the assets of the acquiring company. In practice, the private equity will borrow money to purchase a company and then dump the entire debt on the company that they just purchased. This forces the newly purchased company to start cutting costs until eventually the company goes out of business. Now, this is important because for people who are investing in a 401k, most likely through your job, a new policy update by the Trump administration may be affecting your retirement plans due to these private equity funds. For many years, the private equity funds have been trying to invade the retirement contribution savings plans that people most likely use as part of their wages to invest at their place of work. Now, these private equity funds are interested in those retirement contribution savings plans because it makes up a net worth of roughly $6.2 trillion. Now, to put this into perspective, $6.2 trillion is more money than the combined value of companies like Apple, Amazon, Google, Facebook, Tesla, and Netflix combined. Recently, the Department of Labor cited an executive order made by President Trump which removes barriers to economic growth. In this letter, you can see for yourself that the language of the executive order allows private equities to be permitted to indirectly participate in people's portfolios within their retirement accounts, such as the 401k. Therefore, these private equities can now use leveraged buyouts on companies which are available in retirement accounts like the 401ks. The 401k will have companies which are listed on the public stock exchange. This creates some major problems. Number one, they are considered extremely high cost investments because private equity makes a huge amount of money on the fees for managing your account. In fact, when a private equity sells a company from their portfolio, they can charge their funds a fee of over $10 million without disclosing that to their investors while they eat away at your returns. Also, they are very difficult to judge specifically what is in your investment account and how it is run because these private equity firms are not very transparent with the information that they provide. In fact, these private equity firms are not considered as liquid. This means that these private equity firms are not very easy to sell because they can lock your money in place for at minimum 5 years at a time. In 2010, the Dodd-Frank Act gave regulators more power to invest in private equities. So, the Securities Exchange Commission did some digging and found that about 50% of the private equities had collected fees inappropriately and would have violated the rules on the Dodd-Frank Act. This is made more infuriating when you come to find out that these private equity firms take extremely high risk for very low performance. In fact, in the long term, when you do the research, you will find that these private equity funds underperform most traditional investment accounts like mutual funds, indexes, ETFs, and individual stocks. Great investors like Charlie Munger, Warren Buffett, and Bill Ackman are extremely critical of these private equity funds. In fact, if we look at an article from last year, Berkshire Hathaway had a meeting with investors in which Warren Buffett said, "We have seen a number of proposals from private equity firms where the returns were not calculated in a manner that I would regard as honest. If I were running a pension fund, I would be very careful about what was being offered to me. More than likely, these funds will not be available to invest directly. Instead, they will be hidden inside your target date funds, which, according to Fidelity, roughly 52% of all Americans that have a 401k actually own target date funds. Therefore, this affects a huge amount of people from the beginning to the middle phase of their careers with their 401k employer sponsor plan. This is more critical, especially if you tend to invest by purchasing these target date funds. Therefore, you should be really careful about what you put into your retirement plans and make sure that these private equity funds do not affect your future through their shady investments. Moving onward, this is a little diagram that I found on Investopedia. You can take a look at this to try and better understand how private equity firms work. Lastly, there was another article about how Trump administration has been offering 401 retirement plans up to these private equity firms, which is a terrible idea. If you can do anything to help yourself, then I suggest that you talk to your financial planner at your work and try and sort things out on that end so that these private equity firms cannot touch the hard-earned money that you earned throughout your work cycle. Okay, moving on, we're going to take a look at my portfolio really quick. This is my portfolio right here. It's doing pretty well. It's getting up there. It's slowly and yet surely recovering despite the market downturns. If we take a look over here, for the past year, my portfolio is down 11.98%, which is a loss of $766. In the past quarter, my portfolio is actually up about 29%, which is a gain of about $2,000. In the past month, my portfolio has a return of 7.46%, causing a gain of about $630. In the past week, my portfolio is up 4.22%, which is a gain of about $366. And just for the past trading day, my portfolio is up 0.09%, which is a gain of about $8. So pretty well, my portfolio is doing just as well and even outperforming the overall market in general, so I'm pretty happy with that. Let's take a look at the dividends produced by this portfolio. So here, as you can see, I earned 16 cents from Amgen, 1 cent from Atmos Energy, 10 cents from Southern Company, 7 cents from Hans Brands. Down here, it says here I've earned 86 cents from Johnson & Johnson, 1 cent from Nordson Corporation, 45 cents again from Hans Brands, 7 cents from AEP, $1.03 from Archer Daniels Midland Company, 46 cents from United Parcel Services, $2.89 from Chevron, 13 cents from Emerson Electric, $5.78 from ExxonMobil, 9 cents from IBM, 5 cents from SPGI, 16 cents from Target, 1 cent from CenterPoint Energy, 27 cents from Microsoft, 3 cents from Skyworks Solutions, 4 cents from Cable One, 6 cents from Dow, 4 cents from PPG, $3.01 from 3M, and lastly, $1.93 from Walgreens. These dividends that I earned are a result of me owning shares of each company. This is money that I did not have to put any effort into earning besides clicking a few buttons to buy shares. Essentially, I'm earning money while I sleep. This is referred to as passive income. Earnings, which are derived from an enterprise like a rental property or company, which require little to no effort to earn and maintain. Although these amounts may seem small, every little bit helps and will eventually snowball into something bigger through compounded interest. This concludes the update portion of my portfolio. Thank you so much for watching this video until the end. If you liked the video, then please give it a thumbs up as it will help the channel grow immensely. If you have any comments or questions, then leave them down below in the video and I'll do my best to personally address it, either in the comments or answer it in future videos. I greatly appreciate everyone watching my videos and I hope to speak to you all again soon.